2025 is shaping up to be a pivotal year for competition law, transaction liability insurance, and public mergers and acquisitions in India. With significant regulatory changes, key market developments, and increasing investor confidence, the horizon appears bright when it comes to M&A activity in India. In this video, our experts will touch upon three major topics that are of keen interest to stakeholders participating in the Indian business landscape. First, the evolution of India's antitrust law and the impact of new regulatory changes on merger control and enforcement. Second, the rise of transactional liability insurance as a critical tool being used to minimize risks in M&A transactions. And finally, the recent changes to India's public M&A regulations and how they are set to boost take-private transactions in 2025.
India's antitrust regime has undergone significant changes in the recent past. I discuss 5 themes for the year. Number 1. Increased merger filings. Due to the introduction of the deal value threshold, CCI is likely to see more merger filings. For example, hitherto, global deals that had limited India business presence but exceeded 20 billion Indian rupees or $238 million in value escaped notification previously, but now they will need notification. Further, the early trends indicate that these filings are not largely tech-related as CCI previously anticipated. Number 2. Complexities for financial sponsor deals. The introduction of access to commercially sensitive information as a criterion to determine affiliate means that merger control filings for private equity deals will get more complex, both in terms of assessing the green channel route and conducting overlap assessment. Number 3. Commitments and settlements regime. The introduction of this regime offers faster resolutions for anti-competitive agreements, but comes with its own set of trade-offs, such as limited appeal options and smaller settlement discounts. 2025 will be an early test for its effectiveness. Number 4. Higher penalties and recovery. CCI's new penalty calculation guidelines, which allow CCI to impose penalty on up to 30% of the relevant turnover, higher penalty deposit in appeals, and recovery mechanisms will likely increase deterrence, encourage businesses to carefully consider their appeal decision. And lastly, digital competition legislation. While this topic has lost some steam in the latter half of 2024, 2025 might see revival paving the way towards introduction of digital competition law, similar to what we have in the EU, that is the Digital Markets Act.
Transactional liability insurance, or M&A insurance, has become a game changer in managing risks and facilitating M&A transactions in India, with growing adoption amongst buyers and sellers. These are the key trends to keep an eye on. First, lower premiums. With increased competition amongst insurers, premiums have drastically reduced, and we expect premiums to remain in this range in the coming year. Second, expanded coverage. There will be fewer standard exclusions, and with insurers' understanding of Indian risks increasing, we will see coverage available for most risks, making M&A insurance a very attractive option. Third, increased adoption. Greater awareness amongst advisors is likely to see them recommend M&A insurance to even strategic and promoter clients. Finally, M&A insurance will continue to be a key component of bid transactions, with sellers seeking limited recourse and buyers having to rely entirely on M&A insurance for any post-transaction claims.
Delisting is a key pillar of the public M&A regime in India, and a recent regulatory change is set to reshape take-private transactions as we know them today. In brief, a new fixed-price delisting mechanism has been introduced, which is completely different from the earlier process of price discovery through a reverse book-build mechanism. In this new approach, an acquirer has the flexibility to offer a single fixed price to take a company private, leaving the public shareholders with the binary option of saying yes or no to the offer price. And in the process, the volatility of reverse book build is completely eliminated. The ability to make counter offers has also been improved, with new thresholds and more flexible pricing mechanisms. This helps ensure that public shareholder expectations are better aligned with the final offer price. Ultimately, the new regime is expected to significantly increase the number of take-private transactions in 2025.